Good morning and welcome everyone to the Moneycontrol live stream. You're watching another edition of Markets with Santo and CJ. Well, it looks like we are in for a muted Friday on the Lal Street. If you look at the cues emerging from the global markets, clearly it seems that the central banking action over the past 2 days has sort of popped the equity bulls' optimism, around the fact that they were expecting that there could be a slowdown in rate hikes going ahead. But at this point of time, Santo, it doesn't seem like the ECB or the Fed are in any mood to slow down their pace of rate hikes.
That is something that the central banks had been maintaining time and again. It's just that the equity market bulls were just not willing to listen to that.
Well, that is true. And yesterday, of course, you had the European Central Bank, of course, surprising the market some bit, by raising interest rates only by about 50 basis points. I say only, of course, it's only in the recent context. 50 basis points still is a very large hike when you talk about the ECB. But they, during the press conference, Christine Lagarde, who is the president of the ECB, she did say that the market needs to stop assuming that we are going to slow down. We need many more such rate hikes to bring inflation under control, because at this point of time, the dilemma both for the Fed as for the ECB, and if you actually look, you can bring India also in that conversation, is that a lot of this inflation is now becoming very, very sticky, very, very entrenched. And if inflation expectations, people start assuming that inflation will remain this high, I think that is where the central banks will lose their battle. So they don't want to do that. They don't want to risk easing off or taking off the accelerator from the foot from the accelerator too soon. And that is why we are seeing the sort of cautiousness or warnings that we are seeing from central banks over the past 2 days. Now, where does that, put the rally that we have seen in the benchmark indices at home since probably around, mid-June? Right now, we are sitting in record high territories. We are sitting at record high valuations. Now, when you have a setup like that, and at the same time, you're not seeing any new triggers come out, the hope of a slowdown rate hikes, it seems, is slowly and steadily petering out. At the same time, the fears of a recession becoming more deeper and deeper, that is rising, day by day. And also, fresh upgrades on earnings are not coming through. So then what could be the trigger for investors to actually go out and continue to buy this market, Santo? And I think that is why some pockets of the market are now wondering, maybe we could enter another phase of a time correction in this market over the next 6 months. They are not that optimistic that the market could have a very gala time over the next 6 months because of recession fears, the macroeconomic situation, the budget as well, rate hikes possibly at home. All of this culminating into a probably a very weak sort of a gradual decline or gradual correction mode for the market, with assumptions that the Nifty could even fall below the 17,500 or even 17,000. 17,000 is what a lot of analysts feel could be the make or break level at this point of time. They don't really expect Nifty to fall below 17,000 anytime soon, but that could be the point till which we could see correction on the street.
Well, CJ, if the market does fall till about 17,000, then it doesn't look like much of a time correction, does it?
It will only be a 5 to 10% correction. I think market can take that much, I think.
5 to 10% correction is death knell for many of those mid and small cap
yeah,
stocks.
Yesterday I remember I read a tweet who said that, calling a 2% correction from the top a bear market is not cool.
Okay, well, but I think in the interim, what we could see is probably a lot of investors could still persist with the buy on dip strategy, because this is something that has worked quite well for them over the last couple of years. So many of them will still be tempted to try that, and maybe that is where, CJ, I think probably the time correction that you're referring to could come in, because you got a good force of money also coming into the system. SIP inflows have been pretty strong at 13,000 crore now.
True.
So so probably that should kind of provide a cushion to the market, at least in the near term. You might not see a very steep decline, perhaps it could be more of a kind of a time correction. But that said, also what could kind of encourage investors to buy the dip at this point is that India still looks like one of the better economies in the global picture at this point in time. So that's also something that might be weighing on the minds of investors. But that said, it does look like a range bound market for some time.
Yeah, absolutely. I think you had Neelkanth Mishra from Credit Suisse the other day when he was giving out his outlook. a lot of these, foreign brokerages, Santo, at this point of time are suggesting that please do not expect, this year's outperformance to continue next year. Generally, it is very difficult for a market like India to have the sort of performance that we have had the past 2 years, to continue that for a third consecutive years, especially because of the factors that I mentioned earlier. There is going to be a recession likely in the second half in the US, in Europe. Global economy is slowing down. Yes, China is an X factor, and we have to wait and see how that affects. But we also have to remember that a lot of markets out there at this point of time, especially within the emerging market basket, are very, very cheap. They are dirt cheap, and they are seeing improvement. When you talk about Brazil, where the political situation is looking like becoming more stable, they should get their economy rolling on now. China, where the reopening from the COVID pandemic clearly was the big thing that investors were waiting out for. So when you have those sort of market where you can gain much more by investing money right now, it will not make sense for a lot of hot money at least to be parking funds in India. And I think that is why a lot of foreign brokerages are a little circumspect in terms of the sort of returns that India could make. Of course, they are not also saying that we could see a meaningful crash as well, but probably we'll just trudge along as we have been doing the entirety of 2022.
Well, and with that, we move into the market setup. So, what are the Nifty SGX futures telling us?
Well, Santo, they are telling us that we are in for a negative start once more. If you look at earlier in the day, this morning, the cut was almost as big as 100 points, but it has moderated a little bit to about 60 points at this point of time. But cues from Wall Street clearly were quite bad. We saw a rapid sell-off on Wall Street because of the sort of fears that if the Fed continues to remain as hawkish as it is, then it could trigger a much deeper recession than what a lot of economists are expecting. So that battle between the Fed and the market clearly at this point of time is continuing. Also, you saw a breakout rally in the US dollar as well yesterday. US dollar gained against most major currencies overnight, largely because of the hawkishness that we saw coming in from the ECB as well. So not a great setup, but we'll have to wait and see if maybe the dip buyers come back in large numbers, and we could probably end the session maybe in the green territory.
Well, dip buyers, my money is that dip buyers will come rushing in, because anything that looks cheaper compared to the last week's highs is obviously very tempting.
It's an opportunity of a lifetime. It's an opportunity
looks like
of a lifetime.
But that said, at this point, again, the focus has shifted back to technical factors. Traders will be focusing on the 18,200 mark in case the 18,400 mark breaks, which the probability of it looks high this morning, given the cues from SGX Nifty. So a quick check at some of the FNO cues as well. We've been seeing short covering in the futures of Godrej Consumer. It's also stock we'll be taking up later in the session. MGL and HPCL. So all these three futures saw a fair bit of short covering, and we are seeing short build up in futures of IRCTC. No surprise really there. The OFS is coming up, and the OFS has been priced at a discount to the market price, although the market price is now inching closer towards the OFS price. Metropolis, that stock again has been under pressure for quite some time. No respite really there. SRF and Tech Mahindra are the other futures in which we are seeing build up of short positions.
Well, thank you for those FNO cues, Santo. Moving on to newsmakers of the day, and the first one on my radar today would be GMM Fodder. Now, interesting bit of news coming in wherein the promoter is looking to sell stake in the company through a block deal. Now, this is the quantum of the stake sale that's really surprising, Santo, because it seems like the promoter is looking to sell somewhere close to 30%
that's huge,
of equity.
That is really huge.
Of equity via block deal. Remember, this is coming after they already sold a good chunk of their equity via an OFS, I think some about 18 months ago, which really did create a lot of buzz in the market at that point of time. So very interesting news coming in here, and of course the stake sale is likely to happen, or at least the block deal is going to happen at a 12% discount to the current stock price. So very interesting to see how the market reacts to the promoter almost, it seems, exiting the company altogether.
Well, and my newsmaker for the day is Shriram Transport. The board of the company will be meeting on December 24th. So it's considering two things there. One is the interim dividend. Besides that, it is also looking at raising of funds, which Shriram Transport is also my brokerage pick for this morning. Moving on to that, now Jefferies has rated Shriram Transport as a hold with a target price of 1,365 rupees. Now, according to Jefferies, the net interest margin pressure could result in earnings per growth moderating to about 13% compounded over the next couple of years, and besides that, the assets under management are seen growing at 15% compounded between FY23 and FY25. The big worry, according to Jefferies, probably is the overhang of supply from large non-promoter shareholders.
Well, Santo, my top brokerage pick today is a report coming out from Kotak Institutional Equities on Yes Bank. Remember, Yes Bank had been rallying quite sharply before yesterday's sell-off that we saw. Now, Kotak has reiterated its sell rating on the stock, but marginally raised the target price to about 16 rupees from 14 rupees earlier. Now, according to the brokerage firm, the current valuation multiples of the stock are just totally unjustified, given the fact that there are no new triggers at this point of time on the counter. Remember, the recent rally that we have seen over the past 5 to 6 days has been triggered by the RBI's approval for Advent International and Carlyle to purchase about 10% each stake in the company. Also, the ARC thing going through for Yes Bank, that was also a major trigger. But these were news flows that were already existent in the market for the past 6 to 7 months, or near about. So therefore, Kotak believes that there is no new trigger for the stock to rally in the way that it has. Also, at the same time, Kotak believes that the market's narrative that credit costs for Yes Bank are heading lower and may even become negative if the rate of recovery is much higher than the rate of NPL creation. That, I think, they believe is actually much merited. They believe that that is something that can happen for Yes Bank because of the fact that the performance, the revival of the bank since the near almost bankruptcy back in March 2020 has been much better than what the brokerage firm was expecting. That said, according to Kotak Equities, the bank needs to still do more to justify the sort of valuation. At the current valuation, it is actually trading at a 10% premium to IndusInd Bank, Santo.
That is rich, I would say.
Yeah,
CJ.
And only a 15% discount to Axis Bank. So those are the sort of valuation that market are ascribing to Yes Bank, and Kotak does not believe that this is sustainable in the long run, given the fact that we are still to yet see meaningful revival to justify those sort of valuations.
And also, let's not forget, a large portion of Yes Bank shares currently are locked in. That lock-in ends on March 2023. So you're going to see additional. Those shares are still out of the system, which partly is
exactly all the private lenders who actually helped keep the bank afloat back. When RBI allowed SBI, of course, SBI took the biggest chunk, about 48% if I'm not wrong. And then there were other private lenders such as HDFC Bank, Kotak Mahindra Bank. All of these did chip in to help save the bank. And these, investors will have their lock-in period ending next year, if I'm not wrong. It was a 3-year lock-in period, which will end in March 2023. So once that lock-in period ends, as you said, it could be a big major selling trigger.
And well, with that, we move on to the stocks on our watch list this morning, beginning with Godrej Consumer Products. Now, the stock has been steadily inching up over the last couple of trading sessions in an otherwise bearish market. That's a typical tendency of investors to seek refuge in FMCG companies or defensive companies whenever the overall market going gets rough. Now,
but Santo, one question: why are they known as defensive companies? Why are FMCG always?
Well, FMCG always because it's generally perceived that their growth is steady, it's consistent, which means that they may not perform in a big way while the market is rising sharply, but at the same time, when the market comes off, because you have an earnings cushion there, investors tend to seek refuge in these kind of stocks.
That basically, I will not fall at least as much as everybody else around me.
If market is falling 10%, I might be down 2%. So that is another way of fund managers showing outperformance, the so-called outperformance. Now, in the case of Godrej Consumer, the stock has been an underperformer in the overall FMCG pack, but things seem to be improving slightly, mainly driven by the softening of raw material prices. So we are already seeing some kind of a volume recovery coming in soaps, and according to Moneycontrol Pro, the gross margins should get back to FY21 levels very soon. Now, the company is most likely to persist with its strategy of gaining market share, improving its volume. So most of the cost benefits that it gets by way of lower input costs will most likely be passed on to customers. Well, we'll take a quick check on the market before we return. Well, a bearish start for the indices. Nifty is down by about 82 points in early trade, and for a change, CJ, it's the first time in a very long time that we are seeing market breadth negative in early trade.
Yes,
more than 1,000 stocks down at this point, whereas about less than 800 stocks are up. Nifty mid cap is also under pressure, down close to about 0.6%. We are seeing the similar trend in Nifty Bank as well, down by close to about 0.5%.
Yes, Santo, I think clearly the broader market keeping up with the benchmark index in terms of the selling pressure at this point of time is the reason why the market breadth is negative. Very interestingly, if you look at the India VIX index, that is up about, I think, 6.5% right now, if I'm not wrong. So India VIX clearly jumping quite sharply, indicating that there is more fear emerging within the market that we could be heading towards a much deeper and steeper correction in the coming weeks. Maybe the Santa rally is no longer on the table, but we'll have to wait and see how the market performs for that next week. Sectorally, if you look at it, is the IT space again at the forefront of the selling pressure. Nifty IT index down about 1.2% on top of the sort of selling we saw yesterday. Nifty Realty index down about 0.4%. Nifty Pharma also weak, 0.4%, and Nifty Metal index down about 0.5%. So clearly a lot of global facing companies at this point of time facing pressure because of the the rising fear of a deeper recession in the US next year.
Well, and coming back to Godrej Consumer Products, the company had guided for a single-digit growth in margins and at the same time double-digit growth in revenues, and most likely will be able to achieve that guidance. Besides, it's also seeing significant improvement in its Indonesian business as well as African business. Africa, currently the margins are about 9%, and the company is hopeful of achieving a margin in somewhere in the mid-teens. And lastly, CJ, because of normal monsoons, we are likely to see improvement in rural spending going ahead, and that is positive for a company like Godrej Consumer Products.
I think, Santo, clearly after what has been a sort of a muted to moderate first half performance in FY23 for Godrej Consumer, there is optimism building up in terms of that second half performance being quite well, especially on the volume front. But I think it's the margins that will be really important for me, because I think any sort of upside on the margins, especially from softer raw material prices, is likely to be quite limited, largely because of the fact that the company at this point of time is on a high spending mode as far as advertisements are concerned. Under the new management, we have seen that ad spends have continued to go up, and they are likely to remain higher in the long term because the company is trying to build a brand loyalty out there in the market, and that takes long-term investment. We know that from history and watching other companies as well. Also, the other thing about Godrej Consumer so far has been that the performance so far has nowhere been near enough to the optimism that we had seen Santo last year when the new CEO had come in. And I think clearly now market will start to lose patience if we don't start to see evidence of a real uptick in performance in Q3 and Q4. Also, lastly, recently there were some rumors going around of a possible change in the top management as well. Now, those sort of rumors, although denied by the company in an exchange filing, I think those sort of rumors are quite an unwelcome distraction at a time when there are already so many doubts emerging over the company's long-term performance. So I think the stock has done well for itself, but going ahead, I think a lot of question marks still remain to be answered. Moving on to the stock that will be on my radar today, and it's a technical pick, a largely technical pick in UltraTech Cement. Now, the stock has recently given a breakout from an inverted head and shoulder pattern on its weekly chart, and if you look at the past couple of sessions, the stock has been making a higher high and a higher low pattern on the weekly charts, which generally is a very bullish sign as far as technical analysts are concerned. Now, according to GEPL Capital, the stock has been able to sustain above its 20-day exponential moving average, and going ahead, it looks like the setup is quite strong to provide at least a 12% sort of upside over the next coming weeks. So this is a technical stock that GEPL Capital is quite excited about, and something to keep on your radar.
Well, CJ, for the last 3 months almost the stock has now been trading in a narrow range. I think what it also seems to show is that the market's fascination with cement stocks, which was running quite high, that has suddenly cooled off a bit. It's been on the wane since the September quarter, and also the quarterly numbers have not been all that inspiring, while some bit of weakness was expected given that largely because of seasonal factors, but the sharp increase in operating cost, and as a result the pressure on margin that was much higher than what the market had expected. Now what it looks like, market is focusing on the pricing cues, the price trends. So far it's been driven by both rise in prices as well as uptick in demand, and right now there seems to be some bit of uncertainty on both fronts, also given the fact that a lot of capacity will be now shortly coming on stream. That is something that cannot be ignored altogether, and if we are heading into a phase where probably you could see some kind of slowdown in economic activity, that certainly won't be good for cement stocks in general. Well, the last stock on our watch list this morning is EIH, or what was formerly known as the East India Hotels. Now, according to Moneycontrol Pro, the stock is among one of the quality names to play the upcycle in the hospitality sector. As you would be aware, hospitality stocks in general have had a good run over the last 6 months. Simply put, there is a shortage of rooms and demand is pretty high. So all hotels have been seeing an uptick in their average room rates. EIH again is no exception. For the month of August, it saw almost a 16% rise in average room rates. And according to Moneycontrol Pro analyst Bharat Giannini, the company has also been able to get price hikes from the usually hard-nosed corporate segment. EIH is looking to add about 22 properties in all over the next couple of years. In fact, it has already made concrete plans for about 14 properties. This will be a combination of both own as well as managed properties, and at the same time it is also considering addition of 8 more properties, and valuations at 22 times 1 year forward earnings. These are also closer to its historical levels. So there's some comfort on the valuation front as well, according to Moneycontrol Pro.
I think Santo, the stock has really done quite well for itself. The entire hotel space has done quite well for itself. But I think going ahead, really execution on the earnings will be really important. I don't think that it's any longer going to be running up on narrative, solely on narrative. I think we need to see more in terms of earnings growth, in terms of whether the capex, because we know that a lot of hotel companies are doing a lot of capex at this point of time, whether this could be a foretelling sign that probably there could be a glut going ahead, especially in an environment where the economy is slowing down. You would not expect the pent-up demand that we are seeing in the traveling industry to continue for too long, because if the economy slows down much more than what the market is still at this point of time expecting, then one fears that if all of this supply comes online maybe over the next 2 years, then there could be a situation of overcapacity that the travel industry did go through prior to the pandemic. So I would be a little circumspect in terms of you cannot now paint the entire sector with the same brush. You have to be a little selective in terms of what sort of stock you bet on, because that first leg of returns are now done for, and I think now from here you will have to separate the men from the boys as far as the hotel industry is concerned.
Well, and with that we wrap up this edition of Markets with Santo and CJ. Thanks for watching and also sending in your feedback.
And guys, keep following us on the social media links that you can see at the bottom of your screen. And for the rest of your financial news, stay tuned to moneycontrol.com and download the Moneycontrol app. We'll catch you again live at 3 p.m. with all the day's action. Till then, have a great day.